Hello and welcome to today's discussion with us and our podcast.
Money Talks.
With me today is the managing partner of DLAC Wealth Advisors, Jason Phipps, and a long-standing financial planner. Today's podcast is dedicated to those who hold deep and strong beliefs and have a charitable inclination. For decades upon decades, the way that our tax code had been written, there were some tax advantages to be able to support these things that you cared deeply about. But the 2017 tax code change, it changed all that to a certain extent. At this point in time, it runs around north of 90% of non-ultra wealthy no longer are able to take tax deductions on their charitable giving. So what we're going to talk about today is how do I do things, or is there a way in a manner that I can, in essence, give away no more than I'm giving away now? I still just want to continue giving the same amount away, giving it away at the same time, but how can I be significantly better off financially by just employing a strategy based upon how the tax code is written now and has been for the past 6 years?
Hello, I'm Danielle Kosick. I've been moderating these videos and now podcasts for more than half a decade for DLAC Wealth Advisors, going back to my early years at Hofstra University, where I ultimately graduated from their journalism school with a degree in broadcast journalism. Welcome back to the many who have been fans of DLAC Wealth Advisors, our podcast series, Money Talks, or those who are new to our educational discussions. Now back to the point of today's discussion. I'm aware donor-advised funds or charitable gift funds have been around a long time. But Jason, would you give us a brief explanation as to what they are?
Sure, Danielle, I'd be happy to. This is actually a topic that I'm pretty passionate about. I've been in the financial services industry since 2000, and I've spent a good amount of my career running trust departments for community banks in Ohio. And when you run a trust department, many of the clients are charitably inclined, and those clients donate to charity because they believe in the charity, and they do it for the right reasons. But if we can get them a tax break while we're doing it, all the better for everyone. I'm going to get into the donor advised fund right now on a high level. Essentially, a donor advised fund is a tool that allows you to put multiple years worth of donations into it at one time, and then pass those donations out over time, allowing you to take advantage of the tax code and get a tax break in the year in which you fund the donor advised fund.
Dad, you noted earlier that 90% or so of those who give to charities are getting no tax benefit. Why is that?
In 2017, Congress passed the TCJA, the Tax Cuts and Jobs Act. And in essence, what it did, for the purpose of trying to have a very significant positive impact on the middle class, it dramatically increased the standard deduction. All right. So let's say prior it, was not much more than $10,000 that a married couple could take in the form of a standard deduction. To make it simplistic for people, you have your gross income, you have your net income. So hypothetically, a family that's making $250,000 a year, if they take a standard deduction of, $10,000, then they're actually paying tax on only $10,000 less. The way it works since 2017, based upon how old you are, that actually standard deduction can vary. But if we just hypothetically, for simplicity purposes today, use a round number of $28,000, that's in the range of what most married couples have as a standard deduction. Okay? So prior, these are the type of things that people used to be able to write off. Some of it you still can, but there are some rules that impacts how much in each category. So prior to 2017, let's say I lived in a home that was worth $800,000 and my real estate taxes was $15,000. I could write off that $15,000. Let's say we'll take state I'm sitting within today, Ohio, and I made $250,000. My state income tax is probably going to effectively be about 4%. So that's another $10,000. So some of this, we're putting up on the screen here so you can see the math behind it. So you have $15,000, which has been taken from my deduction for my real estate taxes, my $10,000 for my state income taxes, and let's hypothetically say that I still have a $250,000 mortgage and I'm paying 4% interest. It's another $10,000. Okay? So in that particular instance, that person has $15,000, $25,000, $35,000, $35,000. So they weren't taking a standard deduction. They were taking an itemized deduction. Let's take that same person today. That same person today, there is a cap called the SALT cap. And some of you may have heard the different political parties arguing over it. And that can be debated whether, who's subsidizing who. Different story. For this, the story is, okay, how the tax code works today. I could take $10,000 in total between real estate taxes and state income taxes. So this family that I just gave you has $25,000 and say they give $3,000 a year to charity. Their standard deduction is $28,000 and their itemized is $28,000. So although they have a very significant mortgage, $10,000 worth of interest, they're not getting any tax benefit on the fact that they're giving to charity. So once again, and we simplify it for everybody, as you see I'm listing it in bulleted form, at what you're looking at is you have real estate taxes, state income taxes, mortgage, charitable giving, and what you don't see as often can sometimes be healthcare expenses. So the first four are the dominant different sources that people use to write off to determine whether they're taking a standard or itemized deduction. Okay? So, Jason, let's bring you into it. Same math. Let's take a family where maybe that mortgage is $100,000 and it's at 4%, so it's $4,000. Say this family gives $7,000 a year to charity. Tell us a little bit about, how can a donor-advised fund be used in that particular manner that's going to impact a lot of people?
Yeah, thanks, Rob. The whole concept is you're bundling your gifts, okay? So you have a charity that you support. Many of our clients give consistently to a charity every single year. The whole concept is instead of giving $4,000 this year, let's give $40,000 this year. Let's put that $40,000 into a donor-advised fund, and then the charity continues. We can give that money away later. We fund it today to get the tax deduction, but we can give the money over time. So now you have a $40,000 itemized deduction.
Yeah, and that's going ahead with the 10 plus the mortgage I said was 4. So you get 14 plus 40, you got 54,000. Clearly you're itemizing. So everything between 54 and 28, you're now itemizing for this family that was given, whether the example I gave 7 or you were giving 4, they were getting nothing for that. So say hypothetically, this family is in a all-in 30% federal state taxes. 54 minus 28 is 26. 26, 30% is $7,800. You do this, you're $7,800 better off.
First, for our audience, what can a gift be?
All right, cash, of course. A lot of people give cash in relatively small increments. They put money in the basket at church. Somebody comes by the house and they, give them a few dollars. That's what a lot of us know in terms of what we do. a lot of people, when you're giving sizable amounts, there's going to be some pretty big advantages of giving appreciated assets. Appreciated stocks are one of the main things that you'll see given as a gift. Hey, one of the greatest jingles of our time. 1877 cars for kids. KARS cars for kids. Cars, cash, appreciated security.
Rob, let's drill down on the appreciated security piece of this, because there's an extra tax benefit in that strategy. So let's say that you have a security that you paid $25,000 for. It's now worth $100,000. And when I say security, it can be Apple stock that you bought at the right price. It can be an ETF. It can be a mutual fund. There's a $75,000 capital gain that's associated if you sell that stock. However, as you know, if you give that stock to the donor advised fund, you don't have to pay taxes on that $75,000 in gain that's embedded in that security. And the charity doesn't have to pay taxes on it either. So it's a true win-win.
You gentlemen are the owners of a successful investing advisory business. What % of your clients would you say this is an appropriate strategy for?
If I had to put a number on it, I'd probably say about 30% of our clients are taking advantage of such. Great question that I've asked of them is this something that you and your accountant are speaking to? And I give that answer to be close to zero. Very interesting why. But I just think, in terms of the role of accountants in today's society, it's much more of a transactional, give me the information and I'll do what I can to save you as much money based upon the information that is provided. But so that means if you have a charitable inclination, there's a 30% chance that you could be significantly better off by employing the strategy that we're talking about today. So whether it's through the gifting strategy or QCDs, and QCDs, we'll talk about it in a moment, which is a very similar strategy, but actually a little bit easier. So if I were to give you a conclusion, is the 30% looks similar to what it was that I explained before, is they do or don't have a mortgage. They probably are paying real estate taxes and some state income taxes. I'd say very few of our clients are not paying real estate taxes and state income taxes, even if they're retired. So you have that situation where you have that core of $10,000 and you have little or any other deduction. So if we just do the math again, let's take a different example and say, all right, I have no mortgage, but I give $7,000 a year. So I got $10,000 for real estate taxes and for state income taxes, $7,000. I'm married. I'm at $17,000. Our standard deduction is $28,000. I ain't getting any write-off. As Jason said, I take that $7,000 and I bundle it for 5 years and go $35,000. So I got 10 plus 35. I'm at 45 minus the 28. It's 17 at 30%. 17, 34, 51, $5,100 better off over a 5-year time period by doing nothing different. And the logistics, if you're not familiar with what a donor advised fund is you simply fund an investment account that is deemed a charitable gift fund, and you get the write-off. Once it has been funded, whether it's you or whether it's the charitable institution that you're working with, because these charitable gift funds are deemed a 501c3. So you may find one that you want to do it through. A lot of local cities, will have their own. I know in Dayton, Ohio, they have what's called the Dayton Foundation. So hundreds, if not thousands, of people that live within that area just provide their donation to the Dayton Foundation. It sits in a brokerage account. You fund it with highly appreciated stock. The stock gets sold, whether it's you or an advisor is then diversifying it. You have access to a website. You go on the website and go, you know what? I want to shoot $5,000 off to my church this year. You go online, your church receives a check that says, in the name of Mr. and Mrs. Smith Charitable Gift Fund, here's $5,000.
So Jason, I guess it's up to you to tell us what QCD means.
QCD is an acronym that stands for Qualified Charitable Distributions. This is a strategy that allows you to take your money from your IRA, give that money directly to a charity, and not have it count as personal income in the year that you do it. So a QCD, once you reach 70 and a half, you're allowed to take up to $100,000 per year from your IRA and give that money to a charity and not pay taxes.
The great news about that is the standard or itemized deduction no longer matters, because you have, let's use a Medicare term, you have a donut hole in my strategy that's not a QCD prior to 70 and a half. So really, if you are 70 and a half or above, you should be doing, and you otherwise would be taking a standard deduction, you should be doing all your charitable giving through QCDs, because from $1, the examples I was given before, the last example I think I gave was 17 to 28, the first 11,000 even that you're giving, you're getting no benefit for. From $1 with the QCD. Because normally if you take money out of an IRA, it's taxable, right?
Correct.
Okay.
Correct. So if you're giving $10,000 to your church on a consistent basis every year, and you're retired, and you have no deductions, and you're in the 22% tax bracket, let's say you're paying 3% on state taxes, that's 25% tax burden on the $10,000 you're giving. So you're giving the money to the church. By not doing a QCD, you're giving the money to the church, and then you're paying the taxation of $2,500. Simply by doing a QCD, you give the $10,000 to the church and you pay nothing in taxes.
And how about the charity?
And the charity still gets $10,000 and they pay nothing in taxes.
Okay. Danielle, QCD, what does it stand for? God. Qualified Charitable Deduction. I want to thank everybody for joining us again today with Money Talks. Have a great day, and I look forward to talking to you soon.
For all podcast or guest-related questions, please email us at dlacadvisors@dlacadvisors.com. For all questions or inquiries into the services that are provided by DLAC Wealth Advisors, please contact us at elliot.singer@dlacadvisors.com. That's Elliot with 2 T's. Please also visit our description for helpful links.